So let's take all the fluff, hype, and narrative out of these companies. Let's look at what's really going on, determine if they're undervalued, fairly valued, or overvalued. Will it provide life-changing returns going forward? Well, in 2020, it was 23 cents. Now it's $1.08. So it's 4x in 4 years. That's pretty solid performance so far. Let's see if it can continue. Well, with Deep Yellow Limited, if you're Jeff Bezos buying a company, you would have to spend $1 billion to buy this company. What will you be getting for that $1 billion? That's how you determine if you're overvalued, undervalued, how much are you actually getting. If you're getting way more, if you're getting $10 billion worth of assets for $1 billion, that's a good deal. Let's see where we stand with Deep Yellow. Significant production capability. Once in production, Deep Yellow will be the largest pure play uranium producer on the Australian Stock Exchange. Production capacity over 7 million pounds per year. Again, at $100 per pound, that's $700 million of revenue per year. With uranium being the new oil, we really have to take note about how much these companies are going to be making, right? Especially with a multi-decade supply crunch on our hands. Really important. It's like buying ExxonMobil in the early days, potentially. Significant exploration upside with potential to develop large-scale, long-life projects within the Deep Yellow portfolio. They say they're delivering on their vision, 7 years successfully establishing a tier 1 uranium platform. Next 5 years focusing on execution to production while further growing the global resource base. So very, very early stage. It's going to take years to get this thing producing. Again, not a problem if the uranium in the ground gets more and more valuable. But we're going to have to take a look at their financials and their assets. So they have cash of $265 million. This report came out in July 2024. As of July 24, they're saying they have cash at $265 million. So for that $1 billion, almost a third of it is cash. Pretty solid so far, right? Strongly positioned to develop TUMAS and pursue growth strategy. These are their assets. They have a massive asset in Namibia, Africa, which is a decent jurisdiction. It's not like some of the other scary jurisdictions. They're saying 125 million pounds of uranium at $100 per pound. That is $12 billion worth of uranium. That is massive. Of course, it costs money to get it out of the ground. Then we have Alligator River. They're saying 33 million pounds. Then we have this one over in Australia, target production 3.5 million pounds per year. So they do have access to a lot of this new oil that is uranium. Well, at the end of the day, what are these assets worth? Right? Again, we're paying $1 billion for this company. What are we getting for it? Well, the net present value, which is the value of the mine when you take into consideration all the future cash flows, deduct all the future expenses, what is that mine worth? Well, they're saying at an $81 per pound spot price, it's $663 million. At a $90 per pound spot price, it's $878 million. This is accounting for all future production, all future expenses. Right there, it seems like there's deep value in this asset. If the market cap is $1 billion, that's what you have to pay for the company, but you're getting $265 million in cash and an $878 million mine, that's a good deal, right? Now, obviously, there's uncertainty. So just because the net present value is this doesn't mean that's actually necessarily what you'd be willing to pay for it, because there's uncertainty, but the financial model is saying that, and that is pretty enormous, right? Almost $1 billion mine. Now the Mulga mine in Australia is much more early stage. Doesn't look like they have a net present value analysis, but they have millions of pounds of uranium there as well. Very interesting. This one could also have a massive NPV realistically, right? We're talking tens of millions of pounds in the ground in a good jurisdiction. When you buy this company, you're getting this massive Australian mine, which is a call option on the price of uranium. And this is the future, right? 2026, they're saying TUMAS is starting in production. Mulga Rock starting in 2028. They're saying TUMAS has 22.2-year life of mine, and then Mulga Rock has a 15-year life of mine. So this could be just a cash cow in the future, especially as uranium prices rise. Massive. They're saying 7 million pounds of uranium per year. That's how you get to that number in 2028. And they're doing a DFS study on Mulga Rock so we can actually figure out the economics and how profitable it is. But Tumas already seems pretty profitable. Very, very interesting long-term company here. And again, they say that they're in a strong financial position with a $265 million Australian cash hoard to confidently develop Tumas and pursue growth strategy. Now, they did an equity raise early in the year. How do they have so much cash as of July 2024? It seems like they issued equity, right? They printed shares into the market. Now they're going to use that money to Moss Development Capital. 220 million Australian dollars are going towards that. And they're spending another 5 million on exploration, and they're putting 5 million into the Mulga Rock project. So this company is all about this Tumas mine, which is a massive mine in Namibia. Bannerman Energy, similar setup, massive exposure to Namibia, maybe slightly more undervalued, smaller market cap, but this asset just has plenty of value with their almost $1 billion worth of mines. And they're saying total debt zero, right? So strong balance sheet, massive amounts of uranium in the ground, lots of cash. So right there, it could be argued that they're slightly undervalued, right? It costs $1 billion. You're getting $200 million Australian, and then you're also getting an $800 million mine. That you're also getting the Mulga project in Australia. So all those assets combined, obviously the net present value of a mine isn't certain. You don't have that cash in hand. You don't have that value in hand. That's the future projected value of the mine. So there's uncertainty. So it should be discounted a little bit. So if you factor in the Tumas mine that they can get into production, that they're going to be profitable with, they're saying in 2026, you factor in the Mulga project, which is going to take more financing, right? They're going to have to either dump more shares in the market, which they likely will when their shares are this high, or they're going to have to get debt. But they can do both, especially if the Tumas project starts to provide them with the capital to fund the Mulga project. Very interesting asset. I wouldn't say screamingly undervalued, right? The market cap isn't a quarter of the assets on its balance sheet. It's probably fairly valued, if not slightly undervalued. Now, if you're a massive bull in this space and you believe that there's a multi-decade supply crunch in uranium and it's the new oil, it really doesn't matter in the long term, right? You want exposure to high quality assets. This asset does not seem extremely undervalued, though. And these are the projections, right? Revenue and earnings per share forecast per Zacks Research, right? Through 2025 for the year, they're getting $2.5 million of revenue, so not very small. And they're going to be losing about a cent per share all the way through the end of 2025. Yeah, and this is kind of in line with what I'm talking about. This is per Jefferies, a research firm, right? Tumas Uranium Project. They're saying it's worth $257 million Australian. That's slightly lower than what the company gave. Mulga Rock, they're saying a $400 million valuation. Angularity Project, they're saying a $297 million valuation. Back out the corporate costs, add in their net cash and debt, and the total equity valuation is $1 billion Australian, right? So the market cap is $1 billion, then it's pretty fairly valued at this range, right? Because that's what the assets are worth currently. Now, as the uranium price goes up, the Tumas project also goes up, right? The company's net present value of the Tumas project was $870 plus million at a spot price of 91, right? So the numbers go exponential as the spot price goes up. It's all based on that. And so their price target is $1.40. In current market conditions, I would say that is totally fair and reasonable. They have plenty of cash, they can get to production. Now, the question is, as the uranium spot price rises, this thing is worth way more. So it's a solid call option on the price of uranium. It has a strong balance sheet, it has a lot going for it. Maybe not quite as undervalued as Bannerman, but a quality asset and plenty of upside if the spot price of uranium skyrockets. So that's what's really going on with this company. No hype, no narrative. I haven't watched any CEO interviews. It's all based on the facts of this asset. So that is the truth. Thank you for watching. If you want me to cover any more assets, just let me know.